Hi, in this session we will look at a very important concept in the world of banking and financial market, term structure of interest rates. Essentially, term structure of interest rates refers to the relationship between the term to maturity and the annualized yield. What this means is, if you say are holding two bonds, one is for a 10-year period, i.e. a 10-year bond, and the other is a 2-year bond, the yield on the 10-year bond would be higher than the yield on the 2-year bond. Similarly, if you take a 10-year loan, the interest rate on that loan would be higher than if you take a 3-year loan. There is a fundamental concept called the yield curve. Yield curve is a graph which represents the relationship between yield, i.e. the returns on the y-axis and the tenor or the time period on the x-axis. As you can see, on the x-axis of the graph is the time period. You go from 0 days to 20 years. And on the y-axis you have the yield or the interest rates. Intuitively, the yield curve should be upward sloping, because remember what we said earlier, shorter the tenor, lower the yield or the interest rates, and longer the tenor, higher the interest rates. Yield curves, interestingly, are not always upward sloping due to changes in the macroeconomic context in any country. By the way, yield curves are constructed for every currency by entities which are nominated to construct the yield curve in that country. Hence, for instance, you have a US dollar yield curve, a euro yield curve, a GBP yield curve, and so on and so forth. The yield curve is constructed every day, a close of business, based on the rates that prevailed for all the tenors in that market where that currency is being traded, using the Nelson-Siegel-Swenson model or some equivalent of that model. The yield curve will normally be upward sloping. Sometimes it could be flat, sometimes it could be downward sloping, and sometimes it could be what we call a hockey stick yield curve. If over a period in time interest rates in a country are going up at the long end and remaining constant at the short end, you will have a yield curve that is pivoting upwards. On the other hand, if the long-term interest rates remain constant and the short-term rates are rising, then you find that the yield curve is pivoting in the opposite direction. Sometimes you would also have parallel shifts in the yield curve, which means both the short-term rates are going up and the long-term rates are going up almost in the same proportion. To understand the yield curve and term structure of interest rates, we will go through a few underlying theories. There are broadly three theories we will be looking at: the pure expectation theory, the liquidity premium theory, and the segmented market theory. There is a fourth one, which is a combination of the first and the last, which is called the preferred habitat theory. Let's look first at the pure expectation theory. Assume the yield curve is flat. In other words, you have a graph that looks like this. Irrespective of the tenor, the interest rate is the same. That situation is hypothetical, rarely happens in any market. What we will look at in the next minute or two is how does this flat yield curve swivel in one direction or the other based on the changes in the macroeconomic realities in that currency market. Let's take an example. Assume that the general expectation about the currency is that interest rates will rise going forward. If you are a saver or an investor and you expect interest rates to go up going forward, you will invest in short-term securities, since you would like to invest in the longer-term securities when the interest rates goes up. In other words, a lot of money flows into the short-term market in the expectation that when interest rates rise, the savers and investors switch to the longer term. Hence, there would be excess liquidity in the short-term market, and as a result, the flat yield curve that we started with will start pivoting downwards, because excess supply of money in the short term, interest rates and yields in the short term would fall. On the other hand, if you're a borrower, you will prefer to borrow right away for the long term, because you know that as time goes by, you will have to pay a higher cost for the borrowing, because interest rates are due to go up going forward. So all borrowers will shift to the long term. What this means is everybody who issues debt securities or everyone who wants to take a loan will go for the long term. What does this do? The demand for funds at the longer end of the yield curve will go up. Therefore, the yield curve will pivot upwards at the longer end. What was a flat yield curve would suddenly, as you can see in that graph, become upward sloping. In summary, when expectations are that interest rates will go up going forward, the yield curve will slope down at the near end and it will slope up at the far end. In other words, the yield curve would become upward sloping. In the discussion board to follow and in the quizzes that we will be taking, we will examine other scenarios of the pure expectations theory.